Hello and welcome to Market Today. I'm Siddharth Zarabi. The markets are absorbing the impact of the union budget and investors are now looking beyond the numbers to what is the future going to be for markets and their portfolios. To help all of you meet your aspirations with solid research-based investment strategies, I'm joined by Piyush Garg, CIO of ICICI Securities, a trusted brand with which you can live the end life. Welcome, Piyush. It's 2 days to after the budget, and I want to begin by asking you, how has the market adjusted now to the overall numbers and the themes in this budget?
Thanks, Siddharth, for having me. So I would say that the budget largely was neutral for the market. A small negative tint is there because of the increased taxation. Correct. So like a short-term capital gain tax has been increased and long-term. So that's a slight tilt towards the negative side, which to my mind was also anticipated by us. Maybe not in this budget, but there was a sense, I think, that was prevailing over last, I think, 4 or 5 years, that government could increase the short term, and they had done as well in terms of increasing the short term tax rate and the long term earlier as well when they introduced it in 2018. So now, obviously, going forward also, there will always be a chance that they again try to increase it. The good thing, I think, about the budget, to my mind, why I call it largely neutral, is that it had a very good macro balance. So one of the reasons why markets are running and they look fine, in fact, from a medium-term perspective as well. In the short term, I still believe that the markets are getting into a reasonably overrated zone, is that there is a macro tailwind which India has been experiencing for the last, I would say, 18 months, 18 odd months. And that is helping. So that has not been disturbed at all. So for example, if you just see one number, which is the fiscal deficit number. So government had 100,000 or 120,000, 1.2 lakh crore of bonanza from RBI dividend. So they decided to split into half. Half they reduce fiscal deficit, that is 20 basis point of GDP, and half they increase the consumption expenditure, keeping the capital expenditure as same. But the capital expenditure as percentage of GDP has almost doubled in the last 5 years. So it's okay even if it was maintained at that level. So they have done that fine balancing act, to my mind, and obviously they needed to boost consumption, boost what you call employment, and I think the way they have done it also is pretty sound to me, because especially this 15,000 rupees that is going to get DBT credit that is going to happen, etc., is basically trying to formalize the economy more and more, which helps, to my mind. Largely. So I would say that I think market has fairly digested now. The move that you're seeing in the market now, starting today, like it opened lower and now it may have almost come up to almost yesterday's level, is largely, I think, now driven by global factors and obviously stock specific as the results keep pouring in. So I think market will decide its way forward depending upon two factors, to my mind. Budget is, I think, the past now. One is how global markets behave, and the second thing is how the results season actually pans out. As of now, if you ask me, the results season, I would tilt more towards a little bit negative, little bit disappointment than any optimism.
Okay, I want to pick up those 2-3 points, but one follow-up on capital gains. A lot of information, charts, tables are being shared on the impact on capital gains. For the bulk of the, investors in the Indian market, those who are in there for the medium to long term, I'm not talking about day trading, how would you describe to them the impact? This is obviously something that they'll have to take in stride. There is no option, but what's a sort of simplified version of the impact that they are likely to anticipate?
So Siddharth, obviously the tax rate has gone up by 2.5%. Okay, I'm just talking about the long-term investor. Short-term, my sense is that most of the the developed countries don't have short-term capital gain tax. It's speculation. Okay, if I buy something in cash today and sell it 2 days down the line, why should I be not paying the marginal tax rate? So short term, my sense is that it should be rather abolished, and there is no need to have short term capital gain. But yes, long term capital gain cannot be taxed at the same as wages. It's different because it helps build the economy. But I think still 12.5%, if I compare it to, or this 12.5 will actually become somewhere closer to 14.5, putting all surcharges together. But comparable to the marginal tax rate of 39%, it is still way below. So it still, I think, is attractive enough. On a relative basis, yes, the attractiveness has come down by 2.6%. You have to pay higher this year versus what you were paid last year. But still, it is much lower. It is still one third of the marginal tax rate for the rich. So I still believe that it is only going to cause a very small dent. The other thing also has one has to see, Siddharth, is that is there any other avenue to put money which where you can actually save taxes or reduce tax rate? That isn't correct. So this still remains from a tax perspective or a post-tax return perspective. Equity still remains one of the best asset class. But yes, if this long-term capital gain tax increases to 20-25%, then that differential between the marginal tax rate and which is 39% for the rich and let's say 25-26%, let's say if they go till there, then that reduces. Then people will start thinking that how much money and that there could be less allocation to equities. That can take place. But
is there a fair Piyush of that happening? Because uh, at the code level, at the income tax code level, there is a review that has been promised over the next 6 months. But if you add STT and the increase for F&O with that, do you fear that a higher tax regime for equity is coming, if not now, but maybe a year, 2 years, 3 years down the line?
I would guess so. I would guess so. Still, there is some room to increase to my mind. And see, yeah, I believe there is, Siddharth, there is room to increase. But I would still say that one needs to be a little bit careful. You should not increase it beyond a point. One should not take it closer to the taxes on wages. That should not happen, or closer to the marginal tax rate. Because see, capital money coming into equities, building capital for the country, it has multiplier impacts, correct?
Yes.
So it's not like wages, which doesn't have any multiplier impact on the economy. So from that perspective, and also one should remember that this is the post-tax money that you invest in the markets.
Absolutely.
Correct? You don't invest pre-tax. So all these things then become double taxation and all that, and attractiveness will lose. And we definitely need a huge amount of capital to build this economy. And equity capital is obviously, I think, very, very desirable. It's a risk capital. So the people who are taking risk needs to be, to my mind, rewarded with lesser tax rate. It cannot be the tax rate of a fixed income market, which is the marginal tax rate, or your wages.
Absolutely, that's an important point, and I think there is still some amount of clarity needed, viewers, from the policy makers as to how they see ultimately capital markets taxation happening. We'll move on from this subject because a lot of people I noticed on social media are now looking beyond the budget, and you also spoke about what's happening overseas and our domestic corporate performance as triggers. What should be the primary focus of investors? Do they need to pay much more closer attention to corporate profitability than all the other news flows that we can continue to see?
Yes, Siddharth, I think that is the single most factor. The reason I'm saying is, if you see the markets, if I just analyze the market for last 6 years, okay, sans the period of COVID when the market showed a reasonable bump up that happened within 6 months, the market almost gave 70-80% return from the lows it was touching. Market has not traded, or market becomes expensive at 25 trailing PE. And market is almost trading at 25 trailing PE. So to my mind, market is definitely in an expensive zone. And the only reason for anyone to keep looking very positively at this market is that if earning growth remains buoyant, because then from a 1 year perspective, 25 becomes, let's say at a 15%, it becomes 22 or something. So which still looks okay from a 1 year perspective. But if the earning growth shows any kind of deceleration in the growth rates, which it looks like from the first quarter numbers which have trickled in till now, I think market may be set for some kind of a correction and further P expansion in the market. I would say that it's a very low probability that market can expand on a P basis at all now. So which means that earning growth will be the biggest driver now in terms of how your returns are going to come.
If earning growth is the biggest driver, and immediately after and during the budget speech, Piyush, I am reminded that the only sector in green was the FMCG index. Let's now try and understand this on a sectoral basis. Which sectors do you think will provide promising returns from a corporate performance perspective?
So I see domestic consumption, Siddharth, doing still fairly well. And there is a focus on domestic consumption. All this employment, etc., this is all going to increase consumption. See, if rich make money, they save more. If the general mass people make more money, then they consume more. So the propensity to consume by a people at lower level is always very high as compared to a person at who's ultra rich. So my sense is that this entire move by the government towards the consumption, towards whether it is a housing scheme that that has been put in the budget, or it is the rural side of the economy, or it is basically this employment generation which they are talking about. I think if it all fructifies, I think it bodes well for consumption. And my sense is that over next few quarters, we would see consumption sectors. Now, this consumption could be, it could be FMCG, it could be people buying, let's say, two-wheelers, cars. Plus, I think the other theme, which is the infra theme, which is all your cement, steel, etc., I think that still remains fine. I don't see any reason to have any negative view on that sector as well. I think we would want to maintain a positive view even on the infrastructure side of the story, because that has been going very strong last 4 or 5 years. And as I said earlier, I think the capex has already doubled as percentage of GDP in the last 5 years. And even if we were to maintain it and not increase it at the rate it has been increasing, I would still say it is fine. It is absolutely fine because the GDP itself is expanding. So I would say that I think all domestic stories, consumption, infra, I think should be fine.
Let me take up infrastructure. The first 3 months for infrastructure from a government spending point of view were obviously hit by the election slowdown. We hope that now government infrastructure rollout starts happening. I put this question to the budget makers, the secretaries of the finance ministry right on the evening of the budget, and ask them that how much of the allocation of 11.11 lakh crore, which has not been tinkered with, is expected to be spent, and do you expect that there will be some sort of savings on that count? And the answer was in the affirmative. Basically, between now and 6 months later, when we have another budget, Piyush, and you know this very well, how much of that infrastructure budget allocation can actually be spent, and what will it mean for immediate term performance on the infrastructure and related sectors?
So you're right. That's a small risk which we run this fiscal. Okay, but market will look ahead to my mind, correct? So one of the reasons to my mind government has not increased the absolute amount of capital expenditure this year is because there is too less a time to spend that money. Almost 1/3 of the year is gone and hardly any spending would have taken place. So it's not only budgeting, it is also the spending. So infrastructure cannot be spent in a day, correct? So it takes time to spend. And if things have started later this year because of elections, etc., that means that to my mind, even this 11.1 lakh crore which the government has budgeted may not be spent. Couple of that money could be spilled over into next year. But the thing is that markets will look ahead. Markets will not look at only this fiscal. Market will try to look at into FY26 as well. And this expenditure is going to happen. It may not happen in this fiscal, as you rightly pointed out, that because lesser time is left, almost 1/3 of the year is gone. But I see this continuing as such. And this has been one of the major drivers of the economy also in the last 3, 4 years. And there is tangible evidence to it. You see how much of roads have got developed. If you travel on highways, I think a huge amount of difference has already been made across India. It's not, if you see this Mumbai to, let's say, Nagpur highway, I think a large part of that highway has got completed in the last 3, 4 years, correct? So I think it is happening and it is happening across. And this I do not think is going to stop. And it's going to continue. As I said, the growth rates that we were seeing, I think we may be somewhere closer to the peak in that growth rates of infrastructure in terms of the spending as percentage of GDP, because government will also look at the consumption side of the economy because they want to lift the lower sections as well at the same time and the middle class. I think that focus will continue. So which means that this could be at a reasonable peak if I have to take next 1.5 to 2 years call. That's how I would put it. But still, this is a huge amount of spending that is taking place. So which augurs well for the sector.
Piyush, within this space, which are the companies that are likely to deliver value and perform better than expectations?
So Siddharth, honestly, I cannot be stock specific on the channel. But this sector, I think people can figure it out. It's large caps. There are a few large cap companies, road construction companies, ports, etc. So conglomerates on the infrastructure side, large behemoths are there in India. We all know. So I think they augur well. Their order book still augurs very well. So I am positive on this side of the economy, and there is a clear focus. Another thing is that the capex side of the story from the private sector has still not, to my mind, boomed at all. It's in a very initial stage, and what this government has done in the last 3, 4 years. And even if there is saturation as percentage of GDP on the capital expenditure, my sense is that the private capex also is very likely to pick up. There is a very high probability. It's already picking up. To my mind, it may pick up further. So I think even if the government was to spend very similar amounts to what it has for the next 2 years, the private capex could lift it. And to me, this sector sounds reasonably promising.
Many states, and Piyush, this will be my last question on the infrastructure space. Many states are laggards when it comes to infrastructure. It's not just the center that has to develop infrastructure, physical infrastructure. Social infrastructure is also developed by the center, but states also have to perform. I wonder if in your analysis and research, there is any state that seems to have, seems promising, because I remember the example of Telangana, where one of our largest infrastructure majors, which has done a metro project, is now seeing a situation where free bus rides are taking away anticipated passengers. So given that drop, do you see certain states that could be outliers?
So yes, I think now some states will try to catch up as well. I'm not very sure. I don't know actually which state will really do much better than the other. But yes, I think even if you see this budget, there was a reasonable focus on, let's say, development in Bihar in terms of, let's say, those temple cities, etc., and even for the capital of Telangana, etc. So I think some of these states will always have a better chance because they have been given extra allocation in the budget itself. But otherwise, I think whatever trend we have seen over last 4, 5 years, I really do not see any major change in that trend.
Fair point. It is continuity and more of the same really that we can see. Modinomics 3.0 continues from Modi 2.0. There are some tweaks responding to some challenges. The defense theme, many people have said completely overbought. The defense expenditure allocation, where still a bulk goes into revenue expenditure and not capital expenditure, that hasn't changed drastically. What's your view on the defense theme?
So it's a good theme, Siddharth. I think this theme, now obviously it is very difficult to pinpoint as to really have the stocks been overbought now or in overbought zone. Or yes, from a historical perspective, if you see many of the stocks in this sector or even in the PSU space, they sound like, yes, they are into a reasonably very high valuation zone than what they have shown historically. But if the focus of the government is there on this particular sector, I would not be too perturbed beyond a point. But yes, one should do their homework well on the valuation front, because some of these stocks are showing excessive valuation and maybe difficult to actually make money. And we have seen when stocks go sideways because of valuation, half a decade can be gone before you realize that the stocks have not given you any meaningful return. So some of these stocks are falling into that kind of a valuation zone where I think making incremental money may become difficult, or they are pricing in a lot of promise ahead already. But sector as a whole, the theme as a whole, the view as a whole on this sector from a government perspective and from a fundamental perspective remains positive. That doesn't change.
Which are the other sectors that you would like to talk about for our investors where they really can build value over time?
So I think banking could be one sector. It has done quite underperformed over the last 1.5 years. So that is where I believe that somewhere during this year, some catch up I would see. So if you are just looking at some incremental alpha, I think there is a possibility that the banking sector may to somewhat start outperforming somewhere during this uh, towards the, let's say, the second or the towards the third quarter of the fiscal year or something. So somewhere towards the second half of the year, I see that to happen. One of the reasons, obviously, being that the interest rate environment may become conducive to the banks as they start, as RBI starts cutting rates, and as the monetary policy eases further. So the liquidity, etc. When liquidity also needs to, it's already improved for the banking system. That will also, I think, further improve for the banking system. And obviously, banking is it moves with the economy. So, and you can easily assume a credit.
But Piyush, sluggish deposit growth, is that likely to change or that challenge will continue for our banks?
See, I think I would put it, it's not a sluggish deposit growth. I would say that, see, whatever, even if the money is moving into equities, finally it remains in the banking system. The money doesn't go out of the banking system, even if you are trading more into equities or whatever. The only thing is, I think the composition is now changing as more margin is required, etc. I think they may be more changing towards fixed deposits, and maybe money may be moving a little bit away from savings accounts. I think that is where the banks may be finding some challenge in terms of, because the lowest cost deposit a bank can get is through savings or CASA accounts.
Yes.
So that is, I think, where some bit of challenge the banks may be finding. But my hypothesis is more based upon as you enter into a easing monetary cycle, which has not yet begun. Worldwide, some countries have started cutting it. I think Switzerland has cut, ECB has cut, US is almost on the brink of cutting the rates. So one of the ways to ease the monetary policy is to bring interest rates down. The other is also to improve liquidity into the banking system. So I'm betting on that there is a reasonable chance that the liquidity into the banking system also starts improving if the monetary policy cycle gets into the easing mode, which it has not yet started in India. So that is basically the hypothesis, which may provide more money to the banks. And but yes, that challenge remains in terms of higher cost of deposits the banks have to grapple with. So that I think is continuing. But I think with interest rate reductions, etc., I think it may become better.
Piyush, even as we were speaking, I don't know if you also wanted to speak about the realty space, because a question has come from a viewer and they want your comment on the impact of the removal of indexation benefits. The viewer who is asking this name says that it's a very harsh decision, but in terms of stock impact and possible activity in the real estate space, do you have a comment?
So I think, to my mind, largely people have to pay lesser tax now than what they would have paid with indexation. So it's a very simple arithmetic here. Real estate, if you are looking to sell any real estate property today and it has appreciated significantly, when I say significantly, like multiple times, let's say if you had bought something 20 years back and it has appreciated 6, 7 times in 20 years, then I think your incidence of tax is going to come down by 30% or maybe even 35%. It's only when you have bought it in the last 5-7 years and the property has just appreciated 20-25%, where you could have almost avoided any capital gains because of indexation, is where people may get a hit. So it is very specific to when you bought the property and how long you held it and how much it has appreciated. So if I have to generalize it, I would say it is a actually people are beneficiaries here. So there is a tax incidence which is going to come down, not go up overall. If I see anecdotally, if let's say you had bought something 15 years back and you're looking to sell it today, if I have to just see, let's say, market like Gurgaon, Mumbai, and you can do any calculation, the price that you bought, it would have appreciated at least 5x, 6x, and your indexation would not even be 2.5 times. So even if
absolutely.
you bought so your tax incidence is going to come down. So people should also remember that from 20, it's become 12.5. So it's a very simple arithmetic. If anyone tries to plug in the numbers, they will get the answer that it may be more beneficial to the real estate holder than not. But yes, going forward, this indexation going away. So people who come in for 3-4 years, Siddharth, for them, this indexation benefit which was there, let's say you want to just get into real estate, even make 6-7% return, 6-7% would have been an appreciation. You just be there for 3-4 years and want to get out. So you now will have to pay tax for sure, because 12.5% between the selling price and the cost price. So indexation, which was taking 5-6%, it is very similar to debt. In debt, if you had invested money at 6.5-7%, you were only paying tax on 2%, because 4.5% was indexation. So, but if in property, the appreciation is much larger. So if you're holding for very long, I think people will be beneficial.
Okay, one final question since you brought out debt. What are the prospects for debt investors now?
So nothing has changed, Siddharth, honestly, for debt investors. So it's remained status quo. So we know there is a grandfathering date. If you have invested before that, you keep getting indexation benefit. So my sense would be that people who have invested before 31st of March 2023, unless you need money and if you invested in debt, let it be, because that indexation benefit continues. So your marginal tax rate is hardly, I think, 60-70 basis point, or maybe just a percent you have to pay tax on what you earn. So that one should continue. But I think there are ways to still lower tax rate when you could use balance funds, etc. I think that combination also could be used in case you are largely a debt investor. You could redeem some equities and put more money into balance funds to still maintain your debt equity ratio. So those kinds of things may be done. But largely, if you ask me purely from a debt perspective, I don't think anything has changed for the investor.
Well, that's a very good note to end this conversation on, Piyush, because while several things seem to have changed, but you have helped all of us to look beyond the immediate knee-jerk reaction into a medium and long-term perspective, and things seem to be going well for the broader macro space. And while the markets may correct a bit, like you said, a long-term vision always deliver better returns. Thanks very much for your time with us today. Viewers, with that, it's a wrap on this conversation with Piyush Garg. We'll be back with more. Until then, goodbye.
Hello and welcome. You're